Welcome to this presentation. This is something that presented to a physical audience last week, and I thought let me record it so that it helps others, and also for me to come back to from time to time, so that these kind of things help uh, oneself get more reinforced if I read or see these foundational concepts over and over again, maybe spaced out, maybe watch it once a year or something like that. So today I want to discuss about selling, and if you look at the process of investing, you will find that for most investors, practically 90 to 95% of our effort and time is devoted to the buying process. What stock to buy, what universe to look at, when to buy, how much to buy, etc. But very little time is devoted to getting slightly better at selling. And if you just think about it, uh, most people, if you've read the financial literature, you will find that most people don't talk about selling at all, or say that they're not good at it, uh, and so on and so forth. So I'm not saying that I'm also very good at it, but this is an effort from trying to bring in information, thoughts that I've had over the last 20-25 years, uh, where I've made mistakes, and what kind of process, if can be implemented, can get us to sell better, right? So with that, let's quickly go through. So the obvious disclaimer, disclosure, that this presentation is for educational purposes, and anyway we're not going to be talking specific stocks, but we'll be talking about a process. So that's how it is. Now, to just understand the psychology, right? What we have to understand is that selling is as important as buying, right? And like Jesse Livermore, in Reminiscence of a Stock Operator, mentions that stocks are never too high for you to begin buying or too low to begin selling. There are cases when stocks have gone from 100 to 50, and as an investor, I would think that, okay, how much further can it fall? And then it falls another 50%, right? And we've seen this multiple times in our investing lives. I mean, a JP Infra or a Yes Bank, lots of such examples. Vodafone Idea, Reliance Power. Stocks can fall 90 to 95% to 99%, right? And every time along that way, when it falls, you feel that it has fallen a lot, right? Uh, the next quote is very interesting, about how big people think about buying and selling. So when Rothschilds got the word that the Battle of Waterloo was over, what they did was they did not go out and immediately buy the British government bonds. They knew that there was an information asymmetry. They knew the outcome. The common people did not. So they went out and actually sold. And because they were selling, everyone around them started panicking and selling, thinking that the British had lost. That brought down the price precipitously. That is when they bought again, right? So these are small, points, but the same construct is even used today by very large institutions when they have to sell, right? Uh, the next one is, what do we do, after or during the process of selling? It is basically that selling creates liquid capital, and if you have the patience to wait and the courage to buy and sell, right, when things are not going your way, and you have liquid capital, that is the best combination. the courage and liquidity. And to have that liquidity, you need to be able to sell and book profits or losses as the case may be. And the last word on, in fact, this is very true of the markets in general, not only in selling, is buying at the bottom and selling at the top are typically done by liars. And today you will find, so many people on social media who seem to be great traders, or great investors who've bought the bottom, who've got sold at the top. But what is interesting is, if you are there for a long time, you will see that those people, the names and faces of those people keep changing. The great traders and investors 10 years back are not there anymore. They are replaced by another set of great traders and investors, which should tell you that these people, or this kind of thing does not is not sustainable. So let's now get into the actual process. So first obvious thing is, if you have made a mistake, then you have to sell, right? And the first and most important thing to understand is that mistakes can be made at any time. At any time by anyone. Warren Buffett has made mistakes. Stan Druckenmiller has made mistakes. Rakesh Juniwala has made mistakes. So there's no one who has 100% track record in investing. It's not possible, right? So mistakes will be made. Why mistakes are made is because in investing, irrespective of whether you are using fundamental analysis or technical analysis or macro analysis or whatever, all the data that you have is from the past, and you are investing for the future, right? So you are basically doing some form of pattern recognition, whether it's from fundamental data, whether it is from technical charts, whether it is from time series data in quants. But you're looking at data from the past and you're trying to forecast probabilistically about the future. And the future is always uncertain, right? So if the future is uncertain and all you have got is data from the past, it is obvious that you will not be 100% right? So that is why you need to be aware that you will make mistakes, and businesses and circumstances can change over time. People change over time. So you've bought something with a thesis in mind, and that thesis might undergo a change. If it undergoes a change, you have to reassess, and if you find that what you thought is not correct, then you have to get out. Right? And the last thing that is very important, which a lot of fundamental value investors don't may not agree with me here, is if the stock price does not agree with your assessment, right? It means that you've got something wrong. So you've bought a stock at 100 rupees, it goes down to 90, it goes down to 80, it goes down to 70. Something is wrong somewhere. If not anything else, at least you have to admit to yourself you've got the timing wrong. And usually when a stock falls a lot, it will take its own sweet time to recover. So it's very rare, unless it's an exogenous event, unless it's something which is driven by an external event, like a COVID crash or something like that, where a stock falls from 100 to 70 and recovers in a V shape. Usually you'll find individual stocks fall, create a base, and trade in a range for a long time, and then recover it, go back to its previous highs. And sometimes this takes months, sometimes it takes years, sometimes it takes decades, right? So if ultimately, if your objective is to make money, sitting through very long periods of time of underperformance or no performance is as good as being wrong, right? So uh, that is the way I look at mistakes. So mistakes could be fundamental, mistakes could be related to timing. So why do we make these mistakes? The essential reason why we make these mistakes, if you see, is like, one is we already talked about, is looking at past data and projecting for the future. That's the main reason. The other thing is ego. Now, if I have made a I've spent a lot of time. I've researched a company and an industry, spoken to the management. I really like the management, etc., etc. Done a lot of channel checks, and then I buy, and I put in a lot of percentage of my net worth into it, and the stock doesn't do well, and it goes down, or it doesn't. Something else happens. Sometimes it is we get caught up in our ego. I've spent so much time. I have a sunk cost in it, and we are unable to get out. The other problem uh, is commitment and consistency bias. So what happens is, and this is one of the reasons you will find that I rarely talk about individual stocks when I'm giving TV interviews or when I write, in Economic Times or in Money Control or anywhere else. Is if you write about a stock, a specific stock that you own or that you like uh, in public, it is, you are committing yourself to a particular viewpoint. You say that I like this company, I own this, then it becomes very difficult to suddenly turn around and say that I don't like it and I want to sell it. And this is why my personal opinion is, a lot of people or fund managers or investors who come and talk about their stock picks in public media do a disservice to themselves, because they fall into that mental trap of being unable to sell, because then a lot of questions are raised. अरे अभी तो इन्होंने बोला कि ये अच्छा है, 2 दिन बाद बोल रहे हैं बुरा है. Those kinds of things. The next is price anchoring. So price anchoring again is, I bought at 100, uh, now it is 70. How can I sell? I'll sell when I get back to 100, and those kinds of things. And very closely linked to that is hope. No, at 70, I'm just holding on to hope that whatever way it goes up back to 100. And the last is again something which is very very prevalent in long-term value investors, is that they fall in love with the business, or they fall in love with the management. This is a great guy, great management. They've done great things. It's an amazing business, and it doesn't matter if it goes through next 5 years of pain. I will hold on to it. So those are things that plague people's mind. One great example of realizing your mistake and getting out in recent years is when I've seen Warren Buffett buy and sell IBM within a span of, I think, 5 years. So here is a person who had commitment and consistency bias of continuously saying over decades that he does not understand technology. Then he goes and buys IBM, and he says that I have studied this company for the last 50 years, right? Not 15, not 1 5, 50, 50 years. He buys it. Within 4 to 5 years, he realizes that his thesis is wrong, and then he just completely turns around and says, I probably made a mistake, let me get out. Now, that is something which is not a very easy thing to do. So see it from a psychological perspective. Here is one person who's doing it, probably one of the greatest investors of all time. Not probably, he is one of the greatest investors of all time. Flip his mind twice. One, from saying that I don't understand technology, I'll never buy technology, to buying IBM, and within a span of a few years, again flipping back, saying that I probably made a mistake. So something to be learned from here. The next obvious one, and this is probably the reason why I personally sell the most often, is if you get a better opportunity, you sell. So in my portfolio, typically of across the portfolios that I manage within the research service in Intel Sense, or in the Sri Rama PMS, where I am the board advisor, where the structuring of the portfolios are basically where typically we'll have between 10 to 20 stocks. These are fairly concentrated portfolios. Now, capital is going to be limited, no matter who you are, no matter, even if you are the Norwegian, wealth fund, which is the largest pool of capital probably today in the world. or your Warren Buffett or whoever you are, your capital is still limited to how many number of billions of dollars you have. And capital has an opportunity cost, right? You don't want to, and especially when your capital is limited, like all of us, we are small investors, and our capital is limited from a few lakhs to a few crores. So you don't want a large part of your capital to sit idle for a decade or sit idle for 5 years. You want your capital to work for you, right? And that is why you have to be on the constant lookout for better opportunities. So if you find a better opportunity which likely is likely to give you better returns over the next 3 to 5 years, it is better to sell one of the stocks that you think is you do a comparative analysis and then get out. Now, the biggest challenge in this, and this is also sometimes, I've seen a lot of people face this, and I face this at times also, is it's very difficult to ascertain the relative merit between two stocks. You like, say, for example, you like HDFC Bank and you like SBI, and you think both of them are going to give, excellent returns. I'm just giving, as an example. I don't know whether they will or not. Now, you how do you judge whether this will stock X will do better than stock Y? Very difficult to do that, right? And then people, what they end up doing is they end up buying both. That is not the optimal solution. You have to do, whenever you are getting in that situation, it means that you have not done enough work to be able to distinguish between the two opportunities. So you need to go back and work harder and get a lot more conviction in any one of them. And if you think both those are great ideas, then look at a third one which can be replaced with these, right? So it's a question of going down the ladder one by one and saying which one can be replaced by this one because this is a better opportunity. The third one is very important. Is over a long period of time you've bought a business, it's doing great, but over time, slowly what is happening is it is starting to lose its competitive advantage, right? It's starting to lose its moat. And most of the time, why I've made this as a separate point is, most of the time when a company starts to lose its moat, what you will see is it's very gradual. It's not usually very rapid. It doesn't happen in one quarter. It takes a year, 2 years, 5 years, 10 years, and the it's like a frog in a boiling water pan. And what that entails is you are actually going to lose a large part of capital over time if you hold on to a business which is losing its competitive advantage. And how do you ascertain a company is losing its competitive advantage? One, obviously, is if you see that it is losing its market share, or you can see that there is a rise of significant competitors, or you will find that the product or the service that the company is offering is deteriorating significantly. Now, it could be individually these things, or it could be a combination of these things. And we have enough examples in history, in the past, in the recent past, where we've seen these kinds of things happen. Remember, our parents' generation, there were only two watch companies. Probably 80-90% market share was there by HMT. Then you had Allwyn, if I remember correctly. There was this watch brand that was available. And pretty much anyone in India who wore watches, I'm leaving aside maybe a 0.1% who were buying a Tissot or a Rolex or an Omega imported from outside, those luxury watches. But 99.9% people in India would have been wearing either an HMT or a Allwyn watch. Suddenly, you have a competitor coming in called Titan, and within a decade, HMT is pretty much bankrupt, right? We saw the same kind of thing with Vodafone Idea. one dominant competitor, and the entire industry dynamic changes. We saw similar things with Kodak. Uh, Technology changed. It's the reason it was famous for, the product becomes obsolete, so huge loss of market share. We saw this. We are seeing similar things, but played out over a very long period of time. Is with IBM and Oracle. Their fundamental products are in decline, and that decline will take very long because these companies have been around and in very dominant positions for a very long period. So to replace them will also take a long time. So be very careful and mindful of companies where who are losing competitive advantage over time. This is a similar point, which is a company which is losing growth and or losing market share. So personally, I am a more of a growth investor. So I like looking at companies which can grow their earnings consistently. Now, how will you keep earnings growth over a long period of time? So either the industry has to grow, right? More people need to consume more of the product, right? So just taking random examples, let's say I am making shoes. So over, say, the next 20 years, I need more people to uh, buy and wear shoes if my company needs to keep growing, or I need lesser competitors. Today, if there are 100 players playing selling shoes, tomorrow if there are 10, my market share goes up. So that could be another way that I sell more, or I increase prices and I become more luxury. So today maybe I'm selling chappals, tomorrow I'll sell leather shoes, then I'll sell high end sneakers, sport shoes, etc. So going up the value curve. So these are the pretty much the only ways how growth can continue over a long period of time. Now, when you see that the growth is slowing, right? Most of the time, what happens is in a stagnant kind of a industry or in a low growth industry, it means that the company is losing market share, right? So similar to the last point, right? If you're losing market share, you're losing the dynamism of the business. Business is topping out. Then it means that or you have some structural problems. Either you've taken some missteps, you've taken on a lot of debt, or you've done something, you've tried and diversified, etc., etc. Or the cycle is against you, the industry is degrowing, then you have to get out. Right? Again, lots of examples where industry is degrowing slowly, but it will happen like a hockey stick at some time when the decline will be rapid, which is the fear today with, say, ICE engine vehicles, uh, a lot of these kinds of products. Uh, the next point is just the opposite, when not to sell. Right. So what I've realized over the years is, contrary to what some investors might tell, it is not very intelligent to sell on overvaluation. So let me explain a bit on this. So valuation is a very very subjective process. Right? People, you can bring in 10 investors together, give them the same data, and they will come up with 10 different valuations of the same company. Now, when that happens, it obviously means that uh, you can have an entire spread of valuation for a company at any given point in time. People in the market come with different time frames, different mentalities, right? So a stock today which you think is really overvalued, uh, maybe at a 60p, 70p, 100p, 150p, can remain at 150p for the next 5 years and can grow at 30-40%. Great examples were, the IT pack before the dot com bust. uh, 2003 to 2008, we had a lot of companies which uh, had gone up to 70, 80, 100p. Same thing again happened in that I think 2011 to 2014, 15, 16 period. A lot of companies went up manifold, huge overvaluation. Over time, that valuation contracts. But the point is that if you can get a 3 year or a 5 year window where valuation persists and you sell early, you leave a lot of money on the table. Right? So, and I personally made a lot of mistakes in my life on selling on overvaluation. I've booked out early from Astral Poly. I've booked out early from Symphony. Uh, I've booked out early from Page Industries, from iSure. So Page, iSure were companies which practically I missed. I bought much later, sold very early, those kinds of things. So the point I'm trying to make is that overvaluation can persist for much longer than people can anticipate. And if you look at the other points of selling that I am talking about, you will probably get a better exit than looking at valuations for exit. Another point I want to make while on this point is what I found mostly with investors, and this is irrespective of, and this is with, let's say, 95 to 99% of investors, excluding some of the greats, and that is probably why they are great, is very few are able to digest very big returns. If you buy a stock at 100, when it goes to 200, most people start getting itch on their body. They start getting restless, they start getting sleepless nights. You know, I've doubled my money, let me get out and book some profits. They're perpetually in that fear mode of losing out on the profits that they've made, the paper profits that they made, and they want to book, and take home some of the profits. Now, the point is that if you have to sit through a 10 bagger or a 20 bagger or a 100 bagger, a 10 bagger does not happen in a month, or it will not happen in a day. It will take time. And to get to from 100 to 1,000, it will have to be 150, it will have to be 200, it will have to be 250, 300, 350, 400, so on and so forth, right? So at every point, you will get that urge that it has gone up a lot. And the other point is, it will never be a straight line up. It will not go from 100 to 1,000 in one straight line upwards. It will go to 200, it will come back to 170. It will test your conviction. Then it will go to 220, it will come back to 170 again. Think about the emotional roller coaster, right? One is you made such big profits. Second is not going up, it's coming back, right? And then it goes up again. And it's a very, very emotionally difficult journey to hold on to a stock for a long period of time, right? Sometimes the company is doing reasonably well and the stock is going sideways or going down slightly, and it's because the market is overall bad, and it tests your patience, right? So that is a very, very important point to keep in mind, that great returns require time, require patience, and require you to be able to sit and digest big returns. And the last point here in this, which is again I think very, very important, is if you look for great businesses to invest in, again very rarely, only at the probably the fag end, or the end of a bear market, will you find it really cheap. Great businesses will always be slightly more expensive, or a lot more expensive than their peers or than other companies which are not as good. Right? You will not find a HDFC bank between 1995 to say a 2010-12, that period of 20 years, uh, where it will be cheaper than their competitors. It's not going to happen because you have a great business doing well. Similarly, you can take any such example, right? Any great business will be overvalued compared to their peers, right? So if you are selling because, oh, X is more overvalued than Y, so let me shift from X to Y, it is probably not a good idea. Okay, so this is perhaps where the biggest mistakes are made, and this is one where I want to really caution investors about when not to sell, or how to think about selling on overvaluation. This is another point which I have sort of inculcated in myself. I used to be more of a Buffett-esque investor where I buy and let the stocks compound for 5, 10, 15 years. Now I am, you know, with the amount of data crunching that we've done about history, what we realized is that stocks, again, I mean, this would be more a generic statement, but data will, if you really crunch the numbers, you will see that this is applicable to maybe 95 to 98% of the stocks, is that they will go in a 3 to 5 year burst of good performance, in business terms, not in stock market terms. A stock goes through an upcycle in a typically in a 3 to 5 year time horizon. Typically, also the stock tends to do well in a 3 to 5 year horizon. Although that time frame is shrinking nowadays because probably the markets have become much more dynamic. So you will now probably see a more of a 2 to 3 year cycle. Now, what that means is, if you are playing a business cycle, a business will go through a good cycle for 3 years, then it will do okay-ish for the next 2 years, and then if the management and the business and the industry is good, it will again do well for the next 3 years. Again, it will go into a slump. So something that we are seeing today, for example, in say chemical businesses, right? It had done well for the last 4 5 years. Last I mean, not last 4 5 years. Last 2 years has not been so good. The previous 4 5 years were excellent, and probably the next 4 5 years again, with some time lag from now, again is probably going to do better. So that is how you have to look at businesses, and the advantage here is that we don't own the business, right? I am not Mukesh Ambani, that I own Reliance and I will not be able to sell and get out. I am a minority. I mean, I have point 0.000001% shareholder of a large company, maybe, right? So if the going is good, I am there. I am a I'm absolutely happy to be a fair weather friend. When there are clouds on the horizon, when it is beginning to rain, I am going to pull out my umbrella, run away into somewhere else where the business cycle is in play. So that is what I have now. That is my current thought process. That, tying back to the opportunity cost of capital that I spoke about, very important to keep my capital employed, right? So as an investor, I am looking at return on capital employed for companies. Similar thing I need to do for my own portfolio. I need to look at my return on capital employed, and I cannot, keep a large part of my capital unemployed and just wandering around. Right? Uh, Another analogy I will give is, sometimes, right, you have to amputate a limb. If a person gets gangrene or something like that, or severe frostbite while mountaineering, surgeons have to cut off the fingers or the hand or the leg or whatever to save the person. Similarly, you have to take losses or you have to book profits in individual stocks to protect your portfolio and to grow your portfolio. So that is the way I think about the opportunity cost of the portfolio, and moving from one stock to the other in terms of churning in the portfolio. This is the last point that I have. I've been practicing this for quite a number of years, and I found this very, very helpful for the peace of mind, for mental liberation. Uh, Whenever you are in doubt, and you will be in doubt for a lot of times, right? When the market is, looking very frothy, overall market is looking very frothy. Uh, when you're getting a bad feeling that things are going to go bad, uh, not only about the market, maybe about an individual company. Uh, when you think that uh, either I'm making a lot of I'm getting into that loss zone, or I've got too much profits, and you're really feeling uncomfortable, or your position size, maybe you've bought 5% of your portfolio in a stock, it has done really well, now it is 20-25% of the portfolio, those lot of things, or the management does something which does not sort of align with you, but you want to give it some more time. So any kind of these kinds of situations, what I do is I sell partially. Now, when in doubt, sell half is a catchphrase that I keep in my mind. But here, half does not really mean half. It means at least one third to half. So if I'm in doubt, I'll maybe sell 25% or one third. At least one third is good, or just for starters, maybe 25%. Right, below 25% really doesn't make a difference. And doubt when you're doubtful, you should not go beyond 50%. I always believe that you should always remain invested at least 50% of your portfolio, because you don't know when the next sudden upside will come in the markets, right? And if you're out of the markets, you will probably miss the upswing in the market, especially when it is making a recovery, because typically the recovery also tends to happen very sharply. And again, a lot of your psychological biases will come in, which will prevent you from buying at higher levels. When you've seen a stock or the market at 100 and suddenly it goes to 120, you will wait for it to retrace, and if it does not retrace and it goes to 130, you will find it more and more difficult to buy. And that is why I have seen a lot of people who, once they sell and book profits, are not able to get back in, right? And they sit with cash for a long time, and in the inside really get envious of other people who are making money, or frustrated because they are not making money, and so on and so forth. So whenever you're in doubt, it's always safe to book partial profits or book partial losses. Another tip that I give to people, when I found very few people who are very who find it easy to book losses. So what I tell them is, okay, you have 100 shares, sell 10. What will happen? You see what happens, how it impacts you. क्या हो जाएगा? कुछ नहीं होगा. So once they sell 10, and they see that the world is, the sky is not fallen on their head, then they are more comfortable in selling, right? So stock goes from 100 to 70 to 60, they are unable to sell, they're frozen. The best part is, sell 10%, sell 20%, sell 30%, and then do it mechanical. Every day go and sell 10%, or every week go and sell 10%, and suddenly you'll feel liberated. And I've seen this with at least 100 people that I've told them to. After the first tranche that they sell, then they are able to sell the remaining in one go, because that emotional attachment is gone, right? So that is all I had for today. I hope some of this makes sense, and we spend a little bit more time in thinking about our selling process and improving our selling process. I keep doing that. I keep writing down the mistakes I make, and where I've missed booking profits, where I've missed taking losses. Uh, so over a period of time, I hope I'm getting better, and as and when I keep learning more, and I have more to share, I'll come back and do so. So, if you have any questions, suggestions, examples of how you've used some of these points, or any additional points that you have, do feel free to write to me. And thank you for taking the time to listen.